Hi, folks. Welcome back to Money and Politics. This is, what is today? This is Tuesday, I think, right? May the 18th. I had to actually just check my phone to make sure what day it is. Hope you had a great day and that you'll have a great rest of the week. If it keeps raining here as it has been, I think we're going to be wise to invest in building an ark. There's a couple of things I'm going to talk about today, and I'm not going to be talking so much about Humble. But one of the comments that I got overnight was from someone who was complaining about some of the things that I was saying, as if I was misleading you all, as if you're sheep, and misleading you down the primrose path. And if he didn't say it outright, he intimated that I'm like a pump and dumper, which is silly. You know, I treat you like you're adults, and you are adults, and you're hopefully learning something here. And so what I'm going to say here is, I don't want it to sound like I'm being defensive. That's not my point. My point is to educate you, especially if you are a new or relatively new investor, and educate you to some of the things that I've learned along the way. Now, as I've said before, I kind of happen to talk about Humble a lot because Humble broke into the fore right as I launched the channel back in January. January 25 was when I posted the first video, and that was about Humble, and it got such a response that I tended to stay with it. And it was and is one of the great stories. Why? Well, on one hand, because it's a brand new company, no argument there, right? And it's in a brand new industry. We're talking about a revolution around the world of digital currencies. And we see that trend, not just in Humble, of course, but in things like Bitcoin and Ethereum and Dogecoin and the rest. This reminds me in part, and I'm going to come back to my other point, but this reminds me in part of what happens when you get a brand new industry. Think back to around 1900 when we had the automobile come to the fore. And at first only the rich could have it, and then finally Ford got the price down where the middle class could start to buy cars. But in the beginning, it wasn't Ford and GM and Chevrolet. It was a whole multitude of cars. You had the Dodge brothers, you had Buick, you had Duesenberg, you had Ford. And so after a while, there was a coming together and merging of companies where the weaker players were bought out by the stronger players. That is one of the patterns that we see repeated throughout history as new industries come out. And we see this now in the area of digital currencies and some of what Humble is doing. Someone said, well, why couldn't Google just come in and do this on their own? Well, they can try. I mean, AT&T's trying to come in and steal away the thunder of Netflix. And Disney stopped having their programming on Netflix and now has the Disney Channel, which is doing remarkably well. So Google can try to do this, and yes, Humble will have some competition, but whatever. I mean, the point is I want you to be aware of the process of things. But here's the main point, to go back to the criticism I received from this one person that wrote about after I posted last night's video. And he says he's a PhD in finance. Fine. I don't care. Here's the thing. He's saying, boy, this has gone down by, Humble's gone down by 80%, and I didn't tell you to put in stop losses and all that. Folks, you can trade the way you want to trade. You can pull the trigger when you want to pull the trigger, and you can put stop losses in if you want to put stop losses in. A lot of people would argue against stop losses. Some would argue for them. I mean, one of the first books I ever read on investing was when I was back in grade school. It was written by a Hungarian dancer, Nicholas something, and the guy, How I Made $2 Million in the Stock Market, back when $2 million was a lot of money. And this guy did it by having stop losses. So I've been aware of stop losses since I was in grade school. Generally, I'm not a fan of them, and maybe we can come back to them some other time. But here's my point, my larger point, and I might go perhaps a little longer today, but I am very critical of the way that the industry, the financial industry, treats the average investor. Okay? They don't tell them enough information. They're not upfront. They're not transparent. They frequently, over the years, have charged too much in commissions. Now that's come down to where we have many of the online brokers having no commissions. I use Schwab. You can use whatever you want. Ameritrade is also more or less commission-free. Sometimes they have some caveats there, and E-Trade and others, without going through all of it. But the inference that not just this one, I don't want to make it just about this one critic who was writing on my wall, but the inference that a lot of people in the financial industry do and say is that investing by private investors is too risky and you don't know what you're doing and you're going to lose your money. And so, and I've said this before, it bears repeating. They don't sell how to make money, they sell fear, they sell safety. They say, let us do it for you so you don't get hurt. And in the process, my argument would be, you get hurt. Now, I just recently, and I'm going to say I'm not a fan of mutual funds, which is what a lot of these people who say you ought to be responsible and invest in this responsible and conservative way so you don't lose your money. You ought to be in mutual funds where some smart money guy on Wall Street makes the management decisions for you. So I Googled top mutual funds, and this is what came up. A number of things came up, of course. This is from The Street, Jim Cramer's site. I'm not knocking Jim Cramer. I like Jim Cramer. I'm just saying, of all the things that came up, I picked this. So you can see here, 12 mutual funds. If you want, freeze this and write down the stock symbols on these. Notice, by the way, the mutual funds all end in an X, as in Xavier. Now, number 2 on the list, which I've never heard of before, and I frankly haven't heard of most of these. Number 2 on the list is BIVRX, okay? So let's go over to, take a look at, here's the page for BIVRX. It's at $19.76, as you can see. This is a 1-month chart. If we go year to date, you can see it used to be down to about $12.17 on February the 9th. Unlike Humble, that's right about Humble's top, it went from $12.30 to up $7. So it's had a nice bounce from the beginning of February over the last 3 months or so, okay? Let's take a look for 1 year, and let me take myself out of here for a minute, and you can see it went up to, until just recently, it was at 16, and then it jumped up to close to 20, okay? That's 1 year. Look in the first column, the third line, expense ratio, 3%. Now, folks, I didn't go shopping for this because I wanted to find a high one. I told you what I did. I Googled, I brought up, and here's a list, and I went to pick number 2 here, and this is what comes, 3%. Now, 3% is, I would say, outrageous. And you can go to Vanguard and get the S&P 500, and that's going to be a lot less, a lot less. And let us, I'm going to take myself out of here again for a minute. So let's click on this. And here we go. Let me just kind of clean this up. So right here, I've got this in twice, so let's do that. We have the let me take this out, and you go up here to comparison, and let's just say that S&P 500. How is it done in relation to the S&P 500, this great mutual fund? Boom. Well, over the last year, it's done well. It's done well. How's it done over the last 2 years? It's done pretty good. But you're also paying a 3% fee, and let's say compared to almost nothing by the S&P 500, okay? How is it done compared to the NASDAQ? Let's make that, let's say, green. Boom. So over 2 years, the NASDAQ just under this mutual fund. And if we go to a 1 year chart, it beat, which is impressive. I'll grant you that, okay? I don't know if we can get a 5 year chart on this or not. Okay, over 5 years, it's come up. Well, it's not 5 years old, so we won't do that. Okay, so we'll keep it at 2. But here's the thing, folks. In addition to that 3% charge, and that's an annual charge, there's also what is called, and these tend to be hidden fees, the 12B1 fee, okay? The 12B1 fee was established in the fund, the law under 1940 the Investment Company Act of 1940. Investopedia put out a video I want to share with you about 12B1 fees, because you probably have never heard of these, and you don't realize that you're paying these every month, every year, if you have a mutual fund. And the larger point I'm making here is, when people say, stay away from these crazy stocks, you know, that might go way up and make you a lot of money. And yes, there's risk, and they can go down. And we've seen Humble go down, but we've also seen Apple go down. We've seen any number of things go down over the last 6 months since Humble's been around. And when they say you shouldn't be buying individual stocks yourself, you might lose money, they don't tell you the whole story. And when they say go to mutual funds, they don't compare the performance of the average mutual fund to things like the S&P 500. And typically these mutual funds are grossly underperforming. And they don't talk about the 12B1 fees. Now let me play this little video. It runs about 1.5 minutes. That was produced by Investopedia, kind of like Wikipedia. In other words, they have information about investing. This concerns that fee, and you should know about this.
Mutual funds typically charge between 0.25% and 1% in 12B1 fees for marketing, distribution, and administration expenses. The fee gets its name from the Securities and Exchange Commission (SEC) Rule 12B1. 12B1 fees may seem trivial in the short term, but they add up over time and can reduce returns. For example, a $10,000 investment in a mutual fund that earns 7% per year almost doubles to $19,671.51 after 10 years. However, if the fund has a 12B1 fee of 1%, the original $10,000 investment only grows to $17,908.48. That's a loss of over $1,700 to the investor. According to the SEC, the original purpose for 12B1 fees was to provide incentives to brokers to distribute more mutual funds, thereby creating economies of scale that would lower the average fee per dollar invested. The resulting lower expense expense ratios would then create higher expected returns for investors. In reality, however, the SEC's data shows that funds with 12b1 fees experience higher expense ratios, and the services rendered to earn the fees do not enhance the fund's performance enough to justify the fees.
So the funds are so high they don't justify, and these fees are in the back. Now here's the other thing that you should know before these other people tell you you should be buying mutual funds. Here's something that I got a number of months ago in my own statement, okay? And this is the kind of page that you just kind of toss aside from your own statement, and you toss it aside because it doesn't have the numbers on it. But what it does say in here that I highlighted is the name of the company. I'm not going to say it. The name of the company and financial professionals. This is under a heading called third-party compensation. So XYZ company and the professional financial professionals receive compensation from investment products, sponsors, and other third parties in connection with investments that this investment company makes in securities such as mutual funds, annuities, and alternative investments. And the bottom line is here, under third-party compensation, again, it says this investment company and financial professionals, meaning the stockbrokers, receive ongoing compensation from certain investment products such as mutual funds. So, if you sell a stock as a stockbroker, you're going to get a commission, not at Schwab because you're doing it yourself electronically, but if you go to a stockbroker, that you're getting paying a commission. On the other hand, if they put you into a mutual fund, they're not telling you about the 12b1 fees, and that mutual fund company is giving them compensation every year. You keep your money in there, they're getting a percent of that every year as ongoing income. Now, that is a conflict of interest. Maybe it's a conflict that you want to have, okay? But it's also a conflict that, generally speaking, is not brought up. And it says here, so-and-so brokerage compensation and conflicts disclosure. So they admit this is a conflict of interest. And my point is, folks, yes, they cover themselves by putting it in a sheet of paper in fine print, but they don't tell you about it up front. And those that say you ought to be just investing in mutual funds are often not going into how much money you're going to lose over 5, 10, 15, 20 years, especially if you're investing in a mutual fund that has an annual fee of 3%. Now, the S&P 500 fund through Vanguard, let me see if I can just bring this up on Yahoo Finance. And I know Vanguard is VFINX. Now, that's the Vanguard 500 Index Fund, okay? It's the same as the S&P. The expense ratio for that through Vanguard is 0.14, okay? As compared to the one I showed you, which is 3%. So it's 3% versus 0.14 annual fee for the Vanguard 500. Now, if you had $100,000 in that mutual fund I brought up, and I don't want to pick on them, but on that one that charges you 3% a year, that you're going to pay $3,000 a year in a fund, as compared to 0.1%, you're going to pay $140. That's the difference. On $100,000, 0.14% would be $140 compared to $3,000 in fees. So this is the thing. When we're talking here on Money and Politics, we are going to be talking to point out the things that I've learned over the years that a lot of people in the financial industries want to sweep under the rugs and not share with you. And yes, you could, I'm laughing at myself for going this long. Yes, yeah, you can put your money in a mutual fund. But I'm telling you, you're going to be much better off by using another thing that people criticize me for, which is these leveraged indexes. So we have here in blue, and you can, let me take out the NASDAQ there. You see the blue line is that mutual fund for 2 years. But here's something which, with a much lower cost factor, and this is the 3 times leveraged S&P 500, the UPRO. I hate this light blue. So let's see what the UPRO does. There you go. Over 2 years, it's blasting away the 3% annual fee mutual fund. And you're not going to be paying anywhere near what you would be paying. The expense ratio on the UPRO is just under 1% as compared to 3%. And that will add up, folks. You're paying 2%. So on $100,000, on that purple line, you're going to be paying a fee of $930 a year as compared to $3,000. Now, let's see which one beat in 1 year. In 1 year, there again, the UPRO, look what it's done. Up 176% compared to 100%. And that mutual fund, I'm surprised, is giving you, comparatively speaking, pretty good returns. Now, we also have what I've talked about many times before, one of my favorite, all-time favorite, the TQQQ. And let's make this, what? I don't know. Let's make it gold, I guess. There you go. So under 1 year, we've had recently a downturn, but again, it's doing much better than the in 1 year than the expensive mutual fund, and in 2 years, there you go. The TQQQ is up 206% versus 76% for the mutual fund. And again, that TQQ is not going to be charging you 3% a year. It's going to be, if I can find it, 0.95. So on $100,000, the TQQ, which is the gold line, will be charging you $950 a year on $100,000 versus $3,000 for that blue line that went up over the last 2 years, 76%. So, folks, I'm going to wrap this up, but I'm not trying to be defensive. My frustration and my anger, quite frankly, is that there are people that want to mislead you, and they mislead you by not telling you the whole story. And they don't tell you about the triple leveraged funds that I've said here. And by the way, one of our fellows on Humble brought up something I didn't know, but I like FNGU, and I mentioned this in an earlier video. Let's see what it's done. And let's make that a very dark, kind of a rust color. And look at that. Over 2 years, it is up. This is why I said I liked it. Look at that. 691% over 2 years. Over 1 year, it's up 245%, and that's after it came down some. I don't know, has it been around 5 years? Some of these have not been. So the bottom line is, when you get these people, the naysayers, and even this guy, well, I'm a PhD in finance and all, as I said to him, and I don't think I've mentioned this, but I worked for 3 years at a major university. And there's some smart people there. But I have known over the years people that have PhDs in finance, and not one of them, in my estimation, could go in and run a business. And so when you get these people and they say, well, you're promoting this company doesn't have revenues or it doesn't have earnings and all this malarkey. They're missing it. If you're going to be a good investor, if you're going to be running a business, you have to be able to see value where other people don't see value. And why do we have a discrepancy in pricing? Whether it's in homes or in stocks or in automobiles, because price isn't the only factor, is it? I mean, you see value, or you see here's one of my favorite terms that I had as a businessman and as an investor: underutilized assets. And you take something that should be producing an asset that's not being utilized or underutilized, and you see value in it where someone else doesn't, and you can make money on it. And I've done that in real estate. I've done that by running a business. And the guys with just the book lessons, they've taken their investment courses, they've taken their college courses, they don't have the calluses on their hands. They don't have the grit that it takes to build a business. And what I see, let me bring it back as I close, if you're still with me. What I see with Humble is you got Brian Foote is a guy who's putting his heart and his mind on the line. And it takes grit. You've got to go up and fight hard. And the bottom line from me to you is I'm trying to get you to understand how to make money. And yeah, we invested in Humble, and yeah, Humble's down, but is the race over? I mean, I would say in a company, in a brand new industry, a brand new company, as I said to this critic, if this were a baseball game, we're not even in the first inning yet. The pitcher's on the mound throwing warm-up pitches. This is middle of May. We didn't even have our own stock symbol until 2 months ago. They just hired 15 more people. They just got the regulatory approval to have ETXs in the United States. What, 2 months ago? 5 weeks ago? They just had yesterday the very first ever quarterly earnings in the history of Humble. I mean, as if we have to be reminded how new we are. And you get people, the critics out there, wanting to wave the checkered flag that we lost. We haven't lost, folks. We haven't even begun the race. We're warming up the engine. That's where we are. And these people that say you ought to go down and put your money in mutual funds when they're not telling you the whole story, or you ought to put your money, I heard this on the radio today, a guy saying you ought to be putting your money in bonds as you grow older. Maybe normally when we have bonds that might be paying 5, 6, 7%, but you do not want to be put your money in bonds if someone's telling you that. You do not want to be putting your money in bonds in 2021 when you're going to be getting 1% or less, and we know interest rates are going to have to go up. And if you don't know, as interest rates go up, the price of low-paying bonds will go down. And so going back, what I'm saying is I'm trying to teach you what I know. And I know that the professionals in the financial industry do not give you the whole scoop. And you can be very severely damaged by investing in so-called safe investments. And they're not going to be safe relative to growing your money. And folks, if you're not interested in growing your money, if you're more interested in safety versus anything else, then don't invest. Just keep your money in cash. I mean, why go in the market? The market is going to have volatility. It's going to have prices going up and down. But over time, they go up. And so that's why I don't worry about, I'm disappointed, but it's hardly anything to say that we're out of the game, because Humble or Dig or InMode, INMD, or FNGU, any of the things we've talked about, or the TQQ, just because they might go down for a period of time, doesn't mean that we're down and out for the count. Look again at this top red line. It's been down since February 8th, just like Humble has. It's been a bad market for the last 3 months. But would you want to have invested in that red line? Would you want to be up over the last 2 years 545%? Yes, you can bemoan the fact that you used to be up 1,000% in February, but I would still want to be in that line, right? So if I don't pull the plug on myself here, I'm going to have an hour-long lecture. So folks, let's just say that this channel is about learning as we go along. And I generally don't share as much as I've shared tonight, just to try to make this to where you can, absorb it. And some people are going to look at this and go, oh my God, the guy talked for almost 35 minutes. I'm not even going to click on that. Or you might say, this isn't about Humble. I'm not going to watch it. But I hope you do watch it, because while I probably could have done a bit more organized lesson here on some of this, the lessons I'm telling you here are important. And they're things that I've learned, to my chagrin, over the years, the hard way. So I'm trying to save you money. I have seen many, many cases of where people have been victimized by so-called financial advisors who were not acting in their best interest. And if you know a good financial advisor, wonderful. That's wonderful. I still want you to know enough that you know when you're being lied to, or you know enough that you're not getting the full story. Errors and omissions. What are they leaving out? Those are the omissions. Have you ever heard of the 12B1 fees before? I don't know. I'm going to wrap up here, folks. Thanks as always for watching. I hope you got something out of this. We will probably go back to talking about Humble, among other things, but I'm also on the lookout for other investments you can pick up on. And in the meantime, have a lovely evening, and we will see you tomorrow night.